Everyone is making the same mistake with the interest rate and the housing, and it's causing them to spend way more money. We're going to explain what that mistake is and why you can fix it. I'm here with my lender, Bill Gaylord, and we're going to tell you why lower interest rates actually equal higher housing cost. The reason that people don't realize this is because they don't know what the interest rate actually does. Bill, what does the interest rate do?
The interest rate is basically what the banks can charge for the money that they lend out.
So
And I was going to say, and a lower interest rate means that you would have a lower payment. But a lower payment means that you will probably pay more for the house.
So a lower interest rate means people can borrow money for cheaper,
Correct.
Right? Which means people can borrow more money, correct?
Correct.
Bill, what happens when you give people more money?
When you give people more money, people go out and spend it. And when they spend money, they will spend more money than they maybe feel like they should have on a house.
We just saw this during COVID, right? The government gave people tons of money. What did they do?
They spent a lot of money.
What happened to the cost of goods?
They went up.
They went up.
Inflation.
100%. So when you give people more money, they spend more money. And when the interest rate goes down, people have more money to spend. So why do so many Americans think that lower interest rates equal cheaper houses?
They think that it means cheaper houses because their mortgage payment is lower.
It's
potentially lower.
And this is the biggest mistake they make. They see a $400,000 house at 7% interest, right? And they think, okay, well, if the interest rate goes to 5%, I will get the same $400,000 house at 5% interest. It's going to be cheaper. But Bill, what happens to a $400,000 house if the interest rate goes down by 2%?
It is a lower payment, but you're going to have a mad dash of buyers come into the market going, I want this house at this. I want this house. It's just supply and demand. And people want a house at $400,000 at a 5% interest. They may not want it as so much at $400,000 at 7%.
Well, yes. So as we saw during 2021, those $400,000 houses quickly became $450,000 houses. So what we're going to do for you guys live on screen right now, we're going to show you a $400,000 house at 7% interest using an FHA loan. Then we're going to show you that same house and what it would cost at 5% interest and what your mortgage would be. So Bill, let's start. $400,000 home, FHA loan, 7% interest rate. What is our expected mortgage?
So we would have a loan amount of $386,000 because of a 3.5% down payment on FHA, 7%. The principal and interest would be $2,613.
Okay, so we'd be looking at a $2,600 mortgage, or just principal and interest.
Just principal and interest. You would add taxes and insurance, and you would have MIP, mortgage insurance premium, added to that as well.
So what could we expect for a mortgage payment?
So if I take a look at the average in Clark County, the total payment would be about $3,053.
That is what we came up with. So about $3,050 for that. Now, let's take that same house.
Okay.
Interest rate goes down to 5%. As we saw in 2021, what do you think that price rises up? People think it'll go up 5,000, 10,000, but that's not how real estate works. Because when you give people more money, what do, Bill?
They spend it.
They spend it. So when the interest rate comes down, they don't just spend a little, they spend a lot. So what does that $400,000 house cost now that the interest rate's gone down 2%?
So now it feels a lot better. It goes to $2,548. The principal and interest on it is $2,108.
And what are they paying for the cost of the home?
The cost of the home, though, now, I don't know if they can't get it at $400,000.
Oh, no way. No way. No chance.
Right? So what if it goes up, let's say it goes up by 10%, $440,000?
Yep.
So they're spending an extra $40,000 for the house.
Yep.
They may not see it go out of their pocket, but
it's there.
It's totally there, $440,000, and now their payment is $2,803. So it's still a little bit less, but they paid $40,000 more for the house rather than buying it now.
And what happens to their down payment?
Their down payment goes up to about $15,400. So it's not a huge increase, but there is definitely an increase.
So they've paid $1,500 more for the down payment. They've paid $40,000 more for the house. They have a higher debt to income because now they have to borrow more money. And what they saved was $200 on the mortgage. So what they've traded is $2,400 a year for an additional $40,000 on their price. Meanwhile, the person who bought at $400,000, what happened to them? They've already got $40,000 in equity on their home.
Yes.
Correct? And these are the numbers that we talk about for you guys about why lower interest rates don't always equal cheaper houses. The offsetted mortgage difference by a few $100s in most cases is put in the opposite direction by increased property taxes for buying at a higher number, lower equity gains for buying at a higher number, increased down payment buying at a higher number, and an increase in your loan balance and debt to income by buying a house more expensive than the one you previously got.
So how do people overcome trying to pay a higher mortgage payment right now?
The thing is to understand the interest rate and what it actually does, because what we're comparing is interest rate to equity. If your house is gaining 5 to 6% equity per year, you need to compare that to the interest rate. And if your equity number is higher than your interest rate number, it might be a solid time for you to buy. The fear is just in the interest rate number. But the bigger fear should be in that interest going down and how many people have access to more money to spend.
The other thing to think about too is that the person who bought it at $400,000 and paid 7% interest, they were paying about $400 more per month. Well, when that interest rate goes back down to 5%, they can refinance and their payment goes around $300 less than they buy at the $400,000. So they already saved $40,000 up front.
Yep.
And their mortgage payment will be less when they refinance.
Yes, the real estate market is always time on the market rather than trying to time the market. People who try to time the market are relying on luck. People who are trying to have time on the market are just relying on patience and dedication. And that is why lower interest rates do not always equal lower housing prices.